Hello and welcome to this session in which we will discuss pledging of receivable. Now, what's the idea for pledging of receivable? What is a receivable? A receivable is when you sell goods or product on account. So you sell on account, and let's assume for a particular month or for a particular period, you had $1 million worth of sales, 1 million. Therefore, you created this account receivable. Great. Now, the account receivable means what? It means the customers will pay you later. That later could be 30 days, could be 60 days, could be 90 days. Okay, that's fine. However, you need the money now. Well, if you need the money now, why did you sell on credit? Well, companies sell on credit to be competitive, so they can sell their product, give the customer a period of time to pay. However, at the same time, the company wants to collect their money as soon as possible. Now, one thing they do is they provide an incentive for the customer to pay early. That's one way to get the money early. Another way to raise liquidity, to get the money, to raise cash quickly, is to do what? Is to pledge your receivable. What does that mean? It means you take this receivable, this $1 million of an asset. This is an asset. Receivable is an asset, just like your home is an asset, your car is an asset. You can pledge them. You go to the bank and you ask the bank if they're willing to give you a loan now against that receivable. Now, why would you want the money? Well, to operate the business, you might have a payroll to meet. You need to pay your suppliers. You need to pay bills, utilities, so on and so forth. You might want to take advantage of an opportunity. There are many reasons why you need this money. So one way to do it is to pledge the receivable. Another way to do it is to sell the receivable. Sell means we'll talk about selling of the receivable in a separate recording. In this session, we'll focus on pledging. You pledge the receivable, and in return, you'll get the money in a form of a loan. So what we will be discussing in this session is secured borrowing. And the reason it's called secured, because you are putting up a collateral. You are putting up an asset. So, for example, a mortgage is a secured loan for the bank. Why? Because the bank is secured. In case you don't pay, they take your house. In this situation, it's a secured loan for the bank, because if you don't pay them, they can take over your receivable. Now, bear in mind, banks are not dummy. And at some point, I was a loan officer. In other words, I work in this lending industry. Before they accept your receivable as a legitimate asset, as a pledge, they look at your customer base. They want to make sure that your customers are credit worthy. In other words, they believe the people that you sold to are credit worthy. They are going to pay their bill. Now, how do they do that? How would the bank determine this? They look at their credit score to determine whether they have good credit or not. In other words, the bank would think about it from this perspective. If these were my customers, would I lend them money? If the answer is yes, then I'm willing to take those assets as a collateral. So let's go ahead and focus on the accounting aspect of secured borrowing. The best way to illustrate the secured borrowing is to look at an example. Before we proceed any further, I have a public announcement about my company, FarhatLectures.com.
Farhat Accounting Lectures is a supplemental educational tool that's going to help you with your CPA exam preparation as well as your accounting courses. My CPA material is aligned with your CPA review course such as Becker, Roger, Wiley, Gleam, Miles. My accounting courses are aligned with your accounting courses, broken down by chapter and topics. My resources consist of lectures, multiple choice questions, true-false questions, as well as exercises. Go ahead, start your free trial today.
So let's assume on March 1st, Adam Pledge assigns $700,000 of receivable to Bank of America for a collateral for a $500,000 loan. In other words, Adam has a $700,000 of an AR, an account receivable, an AR of $700,000. What did Adam do? Adam needed $500,000. So they went to the bank and they told the bank, look, here's a list of my receivable. I need $500,000. I will collect the money. Adam will continue to collect the money from their customers, but I need $500,000 today. And as I collect, I will submit the money. The bank would say, yes, Bank of America agrees and assesses 1.5 of the notes payable and an interest on the note of 12%. So Bank of America says yes. Upfront, you have to pay me 1.5% of the value of the note, which is $500,000. Then you're going to have to pay 12% interest annually. Simply put, we're going to do it monthly, 1% monthly. So Adam makes monthly payment to the bank for all the cash collected on the receivable. So that's the deal. So let's take a look at the transaction that takes place on March 1st when Adam walks away from the bank. When Adam walks away from the bank, what would they do? Well, they will have cash of $492,500. Hold on a second. Didn't you say I'm borrowing $500,000? Yes, I'm borrowing $500,000. That will be the note. That will be the credit. I have a note, I have a loan of $500,000, and 1.5% will be deducted up front because the bank wants a fee. Now, this fee is for what purpose? This fee is for borrowing money. What do we call borrowing money? The cost of borrowing money, interest. So if we take $500,000 times 1.5%, the bank will deduct immediately $7,500 and gives you $492,500. Adam, what should you do? Now you want to go to Farhat Lectures, look at additional resources, whether you are an accounting student, CPA candidate, CMA candidate, studying for any professional certification. Invest in yourself. That's the best investment you could make. Good luck and study hard.